Good evening, everyone, and welcome. My name is Kyla Hanington, and I am the Public Engagement and Outreach Division Manager for the Prince George's County Office of Human Rights. It is my pleasure to welcome you here this evening for another in our Does Your Zip Code Impact Your Whole Life series with the Prince George's County Memorial Library System. In this series, we look at the ways where you live, where you've been born, where you grow up, has lifelong impacts from your health to your education, to your economic opportunities. Tonight, we are looking again at housing in follow-up to our conversation in early December. Later on, I'm going to post some links in the chat to the December conversation in case you missed it, and you can watch it on demand later if you'd like. So from that conversation in December, we are thrilled to welcome back one of those panelists, Dr. Bruce Mitchell from NCRC, the National Community Reinvestment Coalition. He's going to present first, followed by one of his colleagues, Adam Rust. And then after that, though they both present, we will have a moderated conversation with Renee Battlebrooks, the Executive Director of the Office of Human Rights, acting as the moderator. But first, I'd like to welcome Dr. Bruce Mitchell. He is NCRC's research's senior analyst. As an urban geographer, he recognizes the crucial role of place in determining the range of economic opportunities available to people. He specializes in the application of quantitative methods, including conventional and spatial statistics, remote sensing, and geographic information systems, GIS, to analyze patterns of inequity in U.S. cities. He is deeply interested in the historical and structural factors which have shaped the present demographic and socioeconomic patterns of neighborhoods. These factors include segregation, redlining, suburbanization, urban renewal, and gentrification. He has published works on environmental justice and disparities in access to financial services for minorities and people of lower socioeconomic status in U.S. cities. Bruce holds a PhD in geography and environmental science and policy from the University of South Florida School of Geosciences. Bruce, it's a pleasure to have you back this evening.
It's a pleasure to be here, Kyla. Thanks so much for that introduction. So tonight we're going to, do first off an overview of some of the information we discussed in our last presentation, how zip codes can impact your whole life. And we're being very specific tonight in talking about this issue of residential segregation and redlining. And I have a few slides here to share. So let me get those working here. So residential segregation, I refer to there being four pillars that really created this situation of residential segregation within American cities. The first of these are restrictive covenants, and these were written right into the deed of a house when you purchased it. And it would be a restriction on the sale of that house where you could basically only sell it to a white person. And this was perfectly legal up until the Supreme Court ruled them as non-binding in 1948. The next topic, redlining, which we're focused on tonight, that's where banks and the Federal Housing Administration refused to make loans in minority areas. Next is steering, and that was the practice of realtors to only show properties for white families in white communities and for black families in black communities. And then finally, we cannot underestimate this, it's social pressure and violence, where black families purchasing properties in white areas were subjected to extreme harassment and violence when they made those purchases by the white residents of communities. So these four factors were in place for decades within this country. And that's why this is such an important issue even today, 80 years after the HOLC redlining maps were created, why residential segregation and this kind of structure persists. It was put in place during a very formative time in the formation of America's neighborhood suburbs, the post-war period. And this was a time in which you had tremendous pent-up demand for housing from the Great Depression and from the Second World War. Returning servicemen were able to avail themselves of VA loans, and also FHA mortgages, which largely finance the development of these large tracts of development in the suburbs of American cities. And this was an opportunity that was made available almost exclusively to white families, that the purchasers in these of properties and mortgages were given to white families almost exclusively. Now, the HOLC, what this is a federal agency. It was formed during the Great Depression era, and HOLC actually did a great deal of good in the sense that it bought underwater mortgages for about 1 million homeowners throughout the United States and kept them from going into default. And they largely purchased these mortgages in a non-discriminatory manner for both white and black households. Where the HOLC is problematic is what they did after that. And that's what was called their city survey program. In this program, they dispatched examiners to over 200 cities throughout the United States, basically every city with over 40,000 population. And they had the neighborhoods in those cities categorized by their lending risk, the perceived lending risk within those neighborhoods. And they looked at things that were very standard for appraisal purposes: the site situation, location, what amenities were available for that neighborhood. But they also looked at both the class, the race, and the immigrant status of that neighborhood. So this information that the HOLC collected, it was systematically recorded in these examiner sheets and then transferred into maps like the one we see presented here of Baltimore. And the HOLC developed this 4-tiered color coding system where the green areas, those were considered to be the very best neighborhoods within the city, going all the way to the lowest graded areas in red that were considered to be hazardous. And in these hazardous areas, you basically could not get a mortgage. It was very, very difficult to access any form of credit for households in these areas. So the HOLC introduced this system, and FHA largely used the same sort of logic in the systems they developed for appraisal and for looking at neighborhoods. They had a parallel program very similar to this. Unfortunately, we don't have the FHA maps available to us today. They were destroyed by the FHA in response to a lawsuit that was brought against them in 1969. So the FHA maps, for the most part, were destroyed. However, we do have one available that we can look at of Washington, D.C. And we'll see that in just a second. So why is this coding on the maps? Why is it important today? Well, what we find is that the areas that were green coded, the best areas, these have much lower rates of poverty, lower proportions of minorities living in these areas. They also have much higher public health and better public health outcomes, higher life expectancy, lower rates of diabetes, obesity, COPD, asthma. The list goes on and how these areas that were considered best basically have much better living conditions than the redlined areas. And here in Baltimore, we can see the Guilford community, a green-coded area, life expectancy of 85.8 years, poverty rate 19%, minority population almost 40%, while West Baltimore, life expectancy 15 years less, poverty rates double, percentage of minorities living in the neighborhood double what they are in the green-coded area in this Baltimore map. So this is a persisting structure of disadvantage and segregation in America's cities to this day. So I talked about the FHA maps and how most of those were destroyed. However, we do have this one of Washington, D.C. There's also one of Chicago that was copied by another source. So those are the only two that are known at this point to exist. This is a 1937 map made by the FHA. It follows a very similar structure to the HOLC maps. They used 8 categories instead of the 4 categories in the HOLC maps. 3 of these categories were for areas that would be considered redlined. They had a G grade, and these are racially, the racial coding is directly in the categorization here, where the G was the lowest grade designed for neighborhoods for white people. The F graded areas, these were areas where African Americans lived and were coded as tending to become slums. And then the very lowest grading was reserved, the H areas, poorest grade of housing, developed specifically for African Americans. So it's explicit. The racial emphasis and criteria are explicit in this FHA map of the Washington, D.C. area, which extends into the Maryland and Virginia suburbs. And this is a little bit easier to see, this map here, where it's been color-coded in red. This is provided by actually the DC Policy Center. You can find this map. It's interactive, very interesting. You can look at these neighborhoods. And here you can see this grading structure, these G areas that were, remember, that's the lowest graded area for a white neighborhood, which extends really quite a bit into Prince George's County. Many of the areas of Prince George's County were graded G. The H area, which was the very lowest grading area, extends in that western quadrant of Washington, D.C., from Deanwood about over into Chillum, I'm sorry, not Chillum, Highland Park and Carmody Heights is that area there. There are several areas that are also shaded in green on this map. The area of Tacoma Park, Hyattsville, and Riverdale were considered desirable and coded green, along with Cheverly. While loaded graded areas, North Tacoma Park, Chillum, Bladensburg, Landover, and then that area we just talked about, bordering with DC and Deanwood. You can also see Anacostia and the Berry Farms area on here coded with the F grade in the lower portion of that map. So looking at that FHA map, what do we see about mortgage lending today in Prince George's County? What I'm going to do is I'm going to present some data that's taken from the Home Mortgage Disclosure Act. And this is for the time period from 2018 through 2020. This is exclusive to Prince George's County. And if we look at Prince George's County today and the mortgage lending going on today, first off, the demographics, PG County, it has a pretty high median family income of $114,000. Low to moderate income families, the threshold cutoff there is $91,000, which in many areas would be a middle income criteria. But in this area, incomes are so high that that's considered a low to moderate income threshold for purposes like the CRA. Looking at mortgage lending itself, and what we see here is that during this time, and I'm having a hard time reading that. I'm going to have to pull up my other slide here so I can see that a little bit better. There we go. Let me see if there's a way to expand this a little bit because the slide is quite small. Okay, there we go. And what we can see from this slide, sorry about that. What we can see from this slide is that home purchase lending consisted of 42% of the loans that were made in Prince George's County between 2018 and 2020. There were also a very high number of home refinance loans. I think they are 37% during the time period. And if you look over in the right-hand segment of this slide, where you see these bar charts for the individual years as 2016, 2018, 2019, 2020. If you look at 2020 for home refinance loans, you can see that they just skyrocketed because of the low interest rates during that time period. A majority of the lending that was done in PG County in that year was actually home refinance as opposed to loans made for home purchases. The next slide shows, well, where did these mortgages go to? Who got mortgage originations during this time period? And what you can see over in the right-hand slide where it has majority minority neighborhood population, well, 96% of the neighborhoods in Prince George's County are majority minority, either majority Black or majority Hispanic. And you can see that for home purchase lending, about 96% of the loans went to these areas. So there seems to be a parity in terms of the percentage of neighborhoods that are majority minority and the number of loans going to majority minority areas. And who were the major lenders in the area? Well, the top lenders in this market, they're often non-bank lenders with Quicken Loans at the very top. They really dominate the market here, made a vast majority of the loan originations in the area. Where you see purchase, what that means is that the mortgage lender actually purchased that loan from another originator. They did not originate that loan and make the decision making, in essence, about whether a loan will be made. They purchased it later on. So the dark black bar there, you can see, of course, Quicken Loans, large number of originations, followed by Navy Federal Credit Union. Substantial number of the originations in the area were made by Navy Federal Credit Union. Then Freedom Mortgage also made a substantial number of mortgages. You go down further in the list and you do start to see some banks appearing in this, like Bank of America, Wells Fargo, T&D Bank, making mostly originations. And in terms of the mortgage originators, what you see here is for Quicken Loans, the type of loans that were originated, they were overwhelmingly conventional mortgages for Quicken Loans, although they did make a fair share of both FHA and VA loans also. Same thing with Navy Federal Credit Union. Heavy reliance on making conventional loans. That changes, though, when you look at some of these other non-bank lenders like Freedom Mortgage, where you see the vast majority of their business was done making FHA and VA loans. First home mortgage, about even parity there. Caliber home loans, Homespire mortgage, even split between conventional and government-backed lending. And that will come into play a little bit later when we look at these type of loans that are being made and the costs, the closing costs for these loans. If you look at loan originations by race, what we find is, what's interesting is that several of these lenders specialized in the Hispanic market. Homespire Mortgage, for instance, 70% of their loans were made to Hispanic borrowers, as was City Lending. So there's some market segmentation and focus here for many lenders on particular markets, in this case, the Hispanic market. Many of the lenders, most of the lenders, made a substantial portion of their loans to African American borrowers in this analysis. But here is where we get into, well, what's the difference between making these conventional loans and the government-backed loans, right? The closing costs. And over on the right-hand side here, we can see that the average closing cost for a conventional mortgage was $4,100, and I think that's $29, indicated there during this time period, 2018 through 2020. The closing costs for FHA and VA loans are double that. They're very expensive in terms of their closing costs. And there are a couple of reasons for this, right? First off, government mortgages, they're easier to qualify for. They have, accept a lower credit score. Additionally, they require a lower down payment, but they require mortgage insurance on all their loans. While with a conventional loan, if you make a 20% down payment, you don't have to pay that insurance. It's written right into the FHA loan or the VA loan. That's the whole purpose. It's a government-backed, government-insured loan, so they're going to charge for that. So they're more expensive for the borrower to get their mortgage access through the FHA or through the VA. Additionally, the appraisal process and the terms for doing the appraisal, they're much more stringent than on conventional lending. The paperwork is more arduous, so government lending tends to be more expensive than conventional lending for borrowers. And if we see who's reliant on these government-backed loans, what we find is that African Americans and Hispanic families, a majority of those families or households, did have to utilize a government insured loan. African Americans, 54.4%. Hispanics, 53% of their loans were government insured. For whites, it was only a third of white borrowers relied upon an FHA or VA loan, and for Asian borrowers, only a quarter of Asian borrowers relied on a government backed loan. And the slide over here, you can see that right portion. It shows kind of who's paying the most, both in terms of the cost and the cost of the origination fees, and also of the APR or the rate. And African Americans have the highest amount, followed by, I'm sorry, Hispanics have the highest amount, followed by African Americans over in that quadrant. So there's some disparity evident in how much people are paying for mortgages based on their race. If we look at denial rates, this is shows denials, and we find that mortgage denials, that Hispanics, their rate was 2.2 times that of white borrowers, or applicants, I should say, while Black applicants, 1.9 times higher denial rate than for whites. For Asians, 1.8 times higher than that of whites. So there's a higher denial rate by race in this area. And the main reasons for denials are, first off, debt to income ratio. That's the largest reason given for denial of a mortgage, followed by the amount of debt that the applicant is carrying, and then the collateral available from the applicant. Those are the three main reasons why denials are cited in the mortgage lending data. So just in conclusion, first off, the HOLC maps, they document the segregated structure of American cities at the time. The underwriting policies of private banks, the FHA, and the Veterans Administration reinforced this structure well into the 1960s, when public policy measures, things like the Fair Housing Act, made redlining and made steering illegal. But this concentrated disadvantage in ways that impact neighborhoods today, because these practices went on for decades. That concentrated disadvantage and disinvestment have resulted in economic, social, and public health impacts. That nationally, redline neighborhoods, they're mostly low to moderate income and minority areas. And then specifically looking at Prince George's County, we find the legacy of redlining and denial of credit evident in the racial wealth gap, mainly. That minority borrowers have higher closing costs related to government-backed mortgages. Their reliance on government-backed mortgages, they're accessible to households with lower credit scores and less capital for down payments. So redlining, it's had a real impact on the racial wealth gap in this country, the ability of families to build equity in houses and to transfer intergenerational wealth from within families has really been impacted by the inability to get credit earlier on when redlining and things like residential covenants and restrictive deeds were practiced in this country. What can we do about this situation? Well, one of the measures that is key to trying to address redlining at a national policy level has been the Community Reinvestment Act, which was put in place in 1977. It was passed and is still operative. It places an affirmative obligation on banks to provide equitable access to credit and financial services within areas that are low to moderate income and areas that are middle and upper income. So the CRA is one of the primary policy tools that we have where we can affect and make some changes to this red line structure that we have inherited. And my colleague, Adam Rust, he is going to talk in more detail about the CRA, how it functions, and how people can participate actually in the CRA and its enforcement.
Thank you so much, Bruce. I'm so grateful that you came back to be with us again. So for everybody watching at home, we are going to bring up Bruce's colleague, Adam Rust, who's going to present. And then after his presentation, we'll have actually a moderated panel discussion, as I said before, with Renee. So I'm just going to take a moment here to introduce Adam to you. He is a senior policy advocate at the National Community Reinvestment Coalition. He advocates on behalf of consumers in emerging areas of financial services, including digital banking, small dollar credit, stablecoin, and payments. He was a director of research at Reinvestment Partners from 2005 to 2020, where he worked on similar issues, and also led a fintech startup. He helped to establish the U.S. Faster Payments Council and is currently serving his second term as a member of its board of directors. Adam published This Is My House, a book outlining policy initiatives for manufactured housing communities in 2005, and later joined the Department of Housing and Urban Development's Manufactured Housing Consensus Committee. Adam has graduate degrees in journalism from the University of Missouri-Columbia, in city and regional planning from the University of North Carolina, Chapel Hill, and in finance from the Indiana University Kelley School of Business. It is a pleasure, Adam, to welcome you here tonight. Thank you so much for being with us.
Great. Thanks, Kyla. And I want to point out that while both Bruce and I chose to wear corduroy sport coats, he's the legitimate academic, and I'm just an imposter looking like that. So, saying that, I'm going to talk a little bit about CRA, the Community Reinvestment Act, but I'll refer to it as CRA, and a little bit about how it works, how it's evolved over time, kind of the rationale for why it was created, and then kind of shift to a little bit about how you can be involved in advocating for your community by using the power of the CRA. So let me jump to the next slide. Let's see, here we go. Okay, yeah. So I'm going to talk a little bit about how CRA started. And the CRA was really something that came out of a lot of concern about the disinvestment that was occurring in American cities in the 70s, and particularly in majority-minority cities. There was just an ongoing disinvestment and really still a noticeable lack of mortgage capital being made available in these communities, even though it was 40 years after the HOLC that Bruce referred to in detail. There was just a lot going on that had not been fixed, and in some ways was getting worse. And the CRA was part of several pieces of legislation: the Fair Housing Act, the Equal Credit Opportunity Act, the Home Mortgage Disclosure Act, that all were kind of passed in this era to commonly address these problems. So kind of the underlying principle behind the CRA is that you can't really have justice without having economic justice. And this is really an important point to underscore. We at NCRC strongly believe that banks do have a responsibility to be involved in the betterment of their communities. That access to capital is really what creates opportunities for people, and that isn't an abstract thing. That is something that we all know deeply, that, for example, getting a mortgage leads to homeownership, and homeownership is how people build wealth. Having access to capital is what can empower someone to start a small business. And these activities have ramifications for the overall security of households. This is the way that parents protect their children from unexpected emergencies. And we know that, the recent data, I believe it showed that 40% of American households had less than $400. So these aren't problems that have been resolved. These are, ongoing problems. And the CRA, by motivating banks to be involved in making affordable capital that's safe in their communities, is a really important tool. So saying that, I want to go on now to the CRA, and I kind of highlighted a little bit about its legislative history. The thing about the CRA is that it uses that term, which you can see up there, an affirmative obligation. So the notion here is not that this is meant to be some sort of tax that institutions are required to pay, but instead that whatever their line of business is currently, if they're a mortgage lender, if they're focused on small business lending, that they should do that throughout the community. And so they should be held accountable to do it, not just, throughout the MSA. That's the kind of unit of analysis that it works on, wherever they have a bank branch. And the reason for that is that it's conditioned on the benefit of having deposit insurance, that if a bank is benefiting from access to Federal Reserve and deposit insurance, that there's a logical rationale to say that should be the reason for them to give back to the community. So they make credit available throughout. This is important, and it's a fairly nuanced approach, because there are some institutions out there that are not involved in all aspects of lending. They might be something specialized, like a credit card bank, for example, and even those institutions can be are able to find ways to provide capital, either in the form of grants, investments, or loans in the community that are sort of consistent with the model and the capabilities that they have. So does CRA make a difference? Well, I firmly believe that it makes a difference. I think this is one of the wonderful things about NCRC is I can really, without any doubt in my mind, say that the CRA is making a difference. And the numbers that you see on this slide, those are through, I believe, 2018. The numbers now would be even larger, but this is an incredible force for creating access to mortgage capital, for providing community development resources in communities. Many people may not be aware that the CRA made a difference at some point in time in their life when they were trying to apply for capital, or when they received a service, or when the bank branch showed up in their neighborhood. But it's very possible that the CRA was at least partially a contributor to that. There has been a fair amount of criticism about the CRA, and this is, I think, an important point to kind of underscore. You may have heard people say that the CRA was a factor in the subprime lending mortgage crisis, and this could hardly be less true. And there's been quite a lot of research to show, and it makes sense intuitively, that the institutions that were making the high-cost subprime loans were ones that were actually not banks, right? They were ones that did not have CRA obligations. They were the ones that were taking the risks. The banks that were offering CRA programs, and in particular, the loans they were using for their CRA programs, were actually capable of, they performed well, right? So, and there's plenty of research to kind of show how those distinctions really bear it out. And it was also the case that when CRA leaves a community, that the community is harmed. So when a bank branch closes in a rural county, there's documented evidence to show that small business lending goes down, and it goes down, for the next decade. It's not a minor blip; it's an ongoing difference. And similarly, the introduction of CRA credit within a community leads to more affordable mortgages. So, very well documented to show that the CRA makes a difference, and that it's not something that leads to banks having to make loans that are not safe. So, having said a little bit about the history, now I'm going to talk a little bit about just how it works. And this is sort of when you get into kind of the regs and all that. each of the three prudential regulators act as evaluators of how a bank is doing their CRA plan. Banks are required to submit a plan. They're expected to list how they should be evaluated. So, for example, they might say our goal is to make, $1 million of affordable mortgage capital available in Baltimore, and to make small business loans to businesses of a certain size in this period of time, et cetera, et cetera. And then they're evaluated against those results. Banks can receive several different ratings, right? Right now there are 4. NCRC is called for 5. We just feel that would give more nuance to the ratings. Most banks receive a satisfactory. A fair amount receive outstanding these days, and on some occasions they receive a needs to improve or a substantial noncompliance. Although those are really exceptions to the norm. The tests are supposed to examine banks for 3 types of activities: lending, investments, and services. But the most important component of a test is the lending test. And as a part of all of these exams, which occur depending upon the size of the bank, once every 3 years or as infrequently as once every 5 years, the public can make comments and say things along the lines of how well or how poorly a bank is meeting the needs for credit in their communities. And these are things that the regulators read, take very seriously, and they make a difference. So going back, when you see these tests, the lending test, which constitutes generally half of the test, can be made up of these different types of activities. Obviously, mortgage and small business, that's pretty straightforward. I want to call out community development financing. That's an area where the CRA has really made a difference. Typically, these are projects that are a little more complicated, that require a little bit more creativity in the underwriting. In my community, I was involved in a project where I worked for a nonprofit on the board. We were buying a dilapidated strip mall. So a typical loan would have looked at it and said, this is really not a feasible product. We don't see a way that you're going to be able to rent these out because so many of them are vacant. But we had good ideas for creating an arts district. So the local bank that did do it was willing to come provide us with a bridge loan, work through kind of a process of thinking about how to build the capital stack over time. This kind of thing wouldn't happen without the CRA, and yet it clearly makes a benefit to the community to have things like an arts district, but that requires some creative work, and the lending test rewards banks for doing that. Going back to this notion, you've heard a low to moderate income, you've heard the term LMI. This is a very important aspect within any of the kind of conversations that surround the CRA. The way the CRA through regulation was inputted was that it would be based along the lines of making sure capital went into low and moderate income neighborhoods. What the CRA didn't do, and what's something that we've been working hard on, really the impetus for the CRA grew out of, in the south side of Chicago, African-American neighborhoods were being systematically denied credit. So the passage of it was highly linked to civil rights organizing. And yet the law, when the regs came out, sort of skirted this issue of race. And that's something that we feel is a real historical wrong that needs to be righted. But for the purposes of how to understand the exam now, it's focused entirely on making credit available to low or moderate income consumers or in low to moderate income census tracts. Those are the kinds of activities that are rewarded for credit. So the investment test, again, that's interesting because what that does is provides an incentive for banks to either place deposits in community development financial institutions, to provide capital to community development corporations, to sort of use their capital to seed some of the lending activity that's occurring by institutions that they themselves are not traditional banks, but are still kind of reaching out perhaps to specialized audiences, small business lenders, things like that. The investment test is a quarter of the rating. And the service test is probably where there's the most space for qualitative thinking on the part of the regulators. One of the main ways that the service test reviews banks' performance is by looking at the branch networks. So if you've had a neighborhood where bank branch closed, that's a concern that the service test is supposed to acknowledge. When bank branches close, and Bruce has done some fantastic research on this, that does lead to problems with access to capital. And I think Bruce has looked at small business lending in the context of branch closures. But banks are rewarded when they do maintain branches in low-income areas. They're also rewarded for other kinds of sort of soft touch things, so financial literacy programs, technical assistance that they provide to small businesses. Those are all kinds of examples, providing bank accounts for people who were previously unbanked. And in some instances, well, increasingly, there's a reward associated with coming up with innovative programs. And this is something that we might get to later in the conversation, but a lot of innovation right now is focused on sort of digital banking, mobile banking, those kinds of things. And the service test is a place where this comes up as well. So all of this is, of course, related to where it's happening. And where it's happening, where it should be happening, is where a bank has a branch. CRA was built in the 70s, updated several times in the 90s. It's in the process of being updated again. But at least for historical purposes, bank branches have been the foundational aspect of how retail banking was delivered. And so the CRA works around that. They assess banks based on either where they have branches or in a subset of the MSAs where they have a branch. And they look at the needs. The actual exam will go through some kind of profile of what the credit needs are in the area, and then the efforts that the bank made to meet these. These assessment areas are another place where comments can make a big difference, because it's entirely understandable that banks are not going to be the best assessors of where there's a need for credit. The community is going to be the one, the set of voices that can really add value in saying this neighborhood, this type of service, these are things that are currently missing. And so the assessment area conversation, the portion of the exam that focuses on that, is a place where those kind of needs come up. So, and I'm going to continue to roll through here. The question right now is, how are we doing, right? How well are regulators holding banks accountable to do this? And the answer that we're going to provide, and this slide is pretty small, so if you can't read it, I understand. Let me tell you a little bit about what it says. It essentially says that right now, less than 2% of banks are getting a failing grade. It's pretty incredible, right? Because there are very few. It doesn't seem like we're at that stage in society quite yet. This slide has another fact which says that there are more than 3/4 of our states, there is not a bank that's headquartered there that received a failing grade. So again, really a sort of a disconnect between what we see on the ground and what the regulators are saying. This is all part of what has been called the friendly regulator hypothesis, that we have regulators that are captured. This is a problem, and this is partially why NCRC is advocating for this fifth grade, because we feel that there could be more nuance if it wasn't pass or fail, but if it was sort of in between, and there could still be some degree of sanction for that could lead to a much better conversation, a much better engagement level by banks that otherwise may feel like all they have to do is kind of rotely fill out the box and they'll get a satisfactory and they can proceed on. Okay. So inflation is a problem. So now the last part really is about getting involved, and I'm going to encapsulate the last 2 bullet points in this section because NCRC wants to be a part of helping you get involved, and we're really ready to be there for you to do that. I like this slide because it's a picture of Gail Shinkada, who is a very famous person in the history of the CRA. She was from the south side of Chicago. She started organizing mainly because she was upset about the quality of the schooling she was seeing. And she realized that the funding for schools was associated with the property tax, which was very localized. And then she realized that, real estate was itself a reflection of the lack of capital being made available in some neighborhoods. And it went from there to there to there. And she founded National People's Action. And she was probably the person who's considered to be most responsible for the passage of the Home Mortgage Disclosure Act, which created a database that Bruce referred. Some of his data comes from that of mortgage lending, and sort of it's iterated over time, and the data has gotten better and better. And then to the passage of the Community Reinvestment Act. And this quote from her really is key because it underscores the point that we want to make about involvement, which is that the community has to be involved in this process for it really to work. We can only expect so much out of regulators when there are regulators who used to work at banks and bankers who used to be regulators, and back and forth. The system is prone to not necessarily hearing the voice in the middle, which is the consumer. And that's the voice that needs to be elevated, and it can only be elevated by organizing, commenting, meeting with banks, things like that. So how do you get involved? The first step, of course, which may or may not be easy to do, is to know when a bank's coming up for its exam. But even that isn't necessarily a have to. It's really important to find a way to meet with your local bank. And that's the kind of thing that NCRC can assist with as well, and talk to them about what kind of credit needs exist, what kind of credit needs aren't being met, what kind of services are needed that aren't there, and to develop this conversation, and as much as possible to make it fact-based, research-backed, and fully participatory. So comment letters are a big part of that, and this is a place that we're really ready to help. If you can make a comment letter, it is something the regulators have to pay attention to, and the banks are required to respond to the comment letters to the regulator. So in some cases, a regulator may be suspicious that something's going on, but seeing it from a comment made by a member of the community is much more powerful. So these kind of comments make a big difference. What can you do to make sure that your comment is good? Well, NCRC can work with you on that. We have resources available to contribute to that. The same conversations come up when there's a merger or an acquisition. We're facing right now kind of an interesting spat in DC because we're going on 15 years without a merger being rejected. So there's some notion that this actually isn't what the Bank Merger Review Act was meant to do. So we want to engage on those things. When a bank merger is announced, NCRC gets involved, and we work on trying to create a community benefits agreement, which is exactly the kind of from the bottom up organizing process that the CRA is kind of founded on, right? And so that's where we will convene meetings with banks attended by members of the community, by organizations that are doing affordable housing, assisting small businesses, financial literacy, different kinds of groups that are in communities, and saying, hey, this is what is missing. And those kinds of statements go into a consensus-driven approach that leads to an agreement, which the bank is eager to do because they want to have their application move through quickly. They're eager to do that, and so these are where the agreements are made that from that come out agreements to make affordable capital, affordable home mortgages, down payment assistance, all those kind of things. So same thing can come up in a branch closure. I don't want to go into too much detail on that because that's less of a big deal, unless it's in an area where there is, where there are only a handful of branches. Then it can be a really big deal, and that's sort of emerging lately because a lot of rural communities are losing branches. There are counties in the United States now that have one bank branch. Maybe they have two. That pretty much says your community is closed for business, right? It's kind of it's pretty challenging. And so those kind of events are increasingly attracting organizing efforts. So NCRC can help. I've kind of mentioned that. We have great resources available. We can provide your organization with output that shows all kinds of data points, tables, maps on how lending is or is not happening in your community. We can drill down into specific areas. I'm sort of volunteering Bruce's department for work here, but because he's the one who does it. But we would encourage you to reach out about those kinds of opportunities. So I'm going to stop there. I think I've spoken quite at length, and I'm going to hand it back over to Kyla.
Thank you so much, Adam. I appreciate so much that you had to offer. And it's kind of like when Bruce came the first time, it was like, oh, we need to have you back and hear even more. But for right now, what I'm going to do is bring Bruce back along with Renee Battlebrooks, who I said before was the executive director of the Office of Human Rights. So welcome back, Bruce. Welcome, Renee. And I'm going to take myself away for you three to chat for a little bit.
Excellent. Thank you, Kyla. Thank you, Bruce. Thank you, Adam. This was really, really helpful. Adam, I just have a quick follow-up. The last thing that you said, when a branch closes, that the regulatory agency cannot prevent it, but basically, the community is heard and et cetera. My question to you is that looked at, or is that a mark when the same bank tries to open up in another spot? I mean, is there any correlation? Do the regulators look at that closure when evaluating?
So you've said a few really key things there, right? First off, they cannot prevent the bank from closing the branch. That's just going to be the
exactly
how American banking occurs. But there are these opportunities to negotiate for, some kind of, solution. In North Carolina, that's where I live. I remember the organization I used to work at, and it negotiated for the building to be the bank branch itself to be sold and then repurposed as a community center. Do the regulators look askance at this? Yes, and it's really a key aspect of the services test to say, we've noticed that in the last 4 or 5 years, you've opened branches in these well-off neighborhoods and closed a third of your branches in lower income neighborhoods. That's a problem. And until you amend these practices, we're not going to allow you to open another branch or close branches in certain areas that without kind of making sure that there's a way to address those needs further. They can get a little bit of a negative mark on their CRA rating.
But it sounds like it's not sort of, the big thing that will give them pause.
Unless it's really, unless the community makes a big statement, they will probably let it pass.
Yeah. So, Bruce, a question for you. What do you think is the impact of, and I'm going to ask it both ways, if somebody who grew up in a certain neighborhood versus, if you grew up in excluded from certain neighborhoods, what is the impact? And the same, what is the impact on a person who grew up in included certain type of neighborhood? I don't know. Does that question make sense? I want to sort of peel that back a little bit. You talked about it, but I want really for our audience member to see both sides of this coin.
So you're talking about maybe differentials in people who grew up in a red line neighborhood versus a neighborhood that was rated best. And
Right.
And I mean, this really impacts, first off, educational opportunities.
Right.
How well is how good is the tax base in an area that has more, best and still desirable neighborhoods, as opposed to an area that had more redlined, hazardous neighborhoods. It affects, access to tax funding. It affects access to healthcare. We're finding that the redline neighborhoods, they have substantially less access to physicians, to optometrists, to a wide range of medical specialists in these redlined areas, as opposed to areas that were graded the best in the city. So it has health impacts in terms of access to parks. Much higher proportion of the area is parkland in the green graded best areas and desirable areas than there were in the hazardous areas. Environmental exposures. The environmental exposures in the redlined areas, they were generally closer to industry, further away from amenities. So yes, it impacts just people across a wide variety of dimensions of their life, from education to health to income.
Right. And then conversely, I guess, the opposite is true for somebody that's had all of the, yeah. So Adam, talk to us about online, digital, mobile banking, the influence that it has on, or whether it has on the Community Reinvestment Act. What does that look like?
Yeah, thanks for asking about that. I think that's something that we really are trying to focus on right now, because everyone is doing online banking. People love mobile banking. People increasingly do. When they seek to get a mortgage, the first place they go is online. They don't walk into their local bank branch and ask for a rate. They go to one of those sites and compare 30 different lenders. And so that sort of break between how banking was traditionally done through your branch, you had a single relationship. Yeah. If you had your mortgage at your bank, you had your savings account, your checking account, maybe you had 2 or 3 other things at your bank. And that's where you went for everything, and you were loyal. And now people have 10 different financial relationships potentially, right? You have your 401k somewhere, you have your mortgage, maybe not at a bank at all, like the examples that Bruce gave. So people are disintermediating, and they're not necessarily using that same branch, and yet the regulators are only focusing on the activity that occurs around a branch. And so this has created this big gap that is sort of becoming more and more of a problem, because now there are institutions that don't do anything through a branch, right? It's all online. And how do you hold them accountable for CRA? So this is a gap that we think, there's a conversation right now that the reopening up of the rulemaking on how to modernize the CRA modernization. This is one of the key aspects of that.
Again, so many questions. Let me ask Bruce, and I have several more for you, Adam, but we may not have time. So Bruce, if you know, or if you can talk about, how did it come to be that taxes on homes was how schooling was funded? Like, what is that about? And we see the disparity when there isn't sort of the larger tax base from, home ownership.
Sure. And this whole issue of the tax base and how that has evolved over time, some of this touches upon suburbanization and this whole issue of white flight that occurred primarily in the 1950s and 1960s, where you had, core downtown areas largely abandoned by the white middle class who moved out into the suburbanized areas. And what that did, of course, was it evaporated the tax base, at least from property taxes, in those areas, in those core areas. So it created this real kind of dual system of opportunities between people living in core downtown areas versus people living in the suburbs, where they have better financing, better schools, better access to a wide range of services. Yeah.
Adam, what happens when a LMI neighborhood is vacated by, let me see, what happens to lending in an LMI neighborhood when CRA is discontinued? Of course.
Well, so there are studies out there that have been done where it's kind of an interesting modeling technique, but you look at a neighborhood that was, let's imagine, just on the edge of qualifying as LMI, right? And then for whatever reason, it jumped right over. And so it got slightly more well off incrementally, 1 or 2 percentage points. And so now it no longer qualifies for CRA. So the Fed has done research on this, and it's really interesting what they find, because they see impacts, but they're slightly different. So they see probably a greater impact on loss of small business capital. And I don't know, that sort of is interesting, right? So that seems to be fairly uniform, that as soon as that happens, there are fewer loans made. The question is, does the effect happen with mortgage lending? It's a little bit less impactful right away, and the degree of the impact isn't as much for whatever reason. And some of this is a function of there being a lot of access to capital through non-bank mortgage lenders. So when there is that loss of CRA lending, a portion, but not all, of the business that does continue to exist is made up by the mortgage bankers. It's still a net loss, but there's a little bit of an accommodation there.
This made me think about COVID and the CARES Act or other programs rolled out. And I wonder about what, if anything, you're seeing as relates to, the LMI community with getting some of those funds through the banks. I heard sort of this discussion that some minority small businesses never had a relationship with the bank to begin with. And so it made it more difficult to get some of those business loans or money that the COVID relief fund. So maybe it wasn't the CARES Act. I don't know. But, can you talk a little bit about that? What you're seeing? Is there an impact, et cetera?
I can address that.
Sorry, thank you, Bruce. I don't know who I'm.
So small business lending and the PPP, Paycheck Protection Program, right? What we saw with that program was, at least in its initial stages, that banks were concentrating on their own customer base first.
Right.
So if you did not have an existing relationship with a bank, you were out of luck in getting a loan to keep your business in operation and pay your employees in the initial stages of the PPP lending. I think that changed somewhat over the course of that program because it went on for about a year and a half, right?
Yeah.
But there were definite effects from that. And this is a whole thing with small business lending, is that relationships are very important. That having a banking relationship is very important for small businesses, because small businesses, when they're evaluating their credit position, they don't use credit scoring in the same way that it's used for home mortgage lending. It's a more complex process, and having a relationship and having that sort of understanding of the capital flows of a business is really critical for the decision making of loan officers for small business lending.
Yeah. Interesting. And Adam, someone is dying to know about the friendly regulators that you referred to and not giving failing grades to banks. And this person is troubled by that. And can you speak a little bit to, like,
is this person a banking regulator? Let me just.
No, sadly not.
Because then
Right.
I think this is a problem that you see throughout all federal regulatory agencies, and I'm speaking to the PG County folks. So you guys are probably, a lot of you work for the federal government, I imagine, but there's a back and forth, and regulatory capture exists. Banking for a long time was especially problematic because banks are allowed to kind of pick their regulators. I mean, it's not a simple thing. It takes a little bit of time to move from one regulator to the other, but it does happen. There used to be one regulator that was deemed to be especially friendly. That regulator they ceased to exist. They became part of the OCC, the Office of the Comptroller of the Currency, which is the regulator that regulates the national banks.
Right.
I want to go back to that COVID question, because one of the things that I have found to be really interesting, and it kind of relates to this larger, you're familiar with the universal basic income issue, and people have been wondering about that, and Andrew Yang really worked hard to put that idea forward, and there was a criticism that said it was free money and people would be irresponsible. But the arrival of the relief money from the pandemic really created an interesting experiment, and what was visible as a result, and I pay a lot of attention to non-bank consumer credit, to payday lending. The payday lenders had an awful time, right? Because people paid off their debt. When they got the pandemic relief money, they figured out, this is a chance to get my personal finances in order, and they paid down bad debt. And too bad for the payday lenders, but great for America. And I think a really telling statement for, people will make good decisions if you trust them.
That is such a beautiful point, actually. Yeah. Dan Hamlin's question, Kyla took it off, but it was, there you go. It seems criminal that government-backed mortgages have more expensive closing costs for low and moderate income borrowers. Yeah, I agree. It seems oxymoronic, like the opposite of what all of these programs are supposed to be. So his question is, any chance those costs can be offset by government grants?
That's for you, Bruce.
Oh, I saw that. That was nice.
It would be, ideally legislative action could be taken on something like that, and you could see see that kind of offset. However, it isn't at this point. I mean, down payment assistance is one very useful policy measure that can help first-time buyers in getting into a house. It's very problematic, government mortgages, because you want to see the credit box extended so that more people are able to purchase a home.
Right.
And their way of doing that, though, unfortunately, is to make a higher cost loan product available.
That is interesting. Are there any, and this is to both, are there any sort of red flags or signs that some of the people that are listening should be aware of, maybe that discrimination may be happening or occurring either in the lending process and sort of home appraisals, in even with the CRA in reinvesting in the community or services, et cetera. And I love what you said, Adam, about sort of getting involved with NCRC. We're going to become, new best friends, because I love this sort of public comment letters, and that's fantastic. I wanted to peel that back a little bit, but if you could sort of, what are some practical things that may be, may not mean that it's going sideways or discriminatory, but what are some of the things that people should be aware?
Bruce, do you want to talk about fair lending testing and what we've seen there?
Yeah, we do fair lending testing, where we actively go out to lenders. We have matched pair testing, where we'll have a white borrower or prospective client and a Black or Hispanic prospective client, and they will go to the bank and attempt to talk to the loan officer. And what we find is that there are very significant differences in their customer service experience and perhaps how they're steered in direction of particular loan products. And that varies from bank to bank and how, I guess, their training regime is for their employees. But yeah, we do engage in fair lending testing actively, particularly for small business lending. And we were very actively involved in that when the PPP program was in place, looking at these disparities in treatment and the customer service experience, and how this results in discouragement on the part of applicants.
Yeah. What are some resources that some of our audience could go to look at to know whether, okay, this rate that's being offered is actually ridiculously high compared to, what are some resources besides your web, your page? We will certainly send them to NCRC, and Kyla, if you have that, we can put that up. But just, I think, what is it? Caveat emptor, buyer beware. And so I think purchasing a house is it's a major thing. And how do you know you're not being taken advantage of? So any resources, we'll certainly do that. One more question, and then I'm not going to keep you gentlemen, because thank you for allowing us to go over just a little bit. So back to kind of something we talked about in the first December program, Bruce, but sort of what's this fine line between gentrification and revitalization?
Yes.
And
Right.
like, what is that tightrope, and what should we be aware of?
Right. So gentrification, that's problematic. And oftentimes these redlined areas, they prepared the groundwork for gentrification. Areas that were disinvested in and where you had high levels of abandonment then become ripe for gentrification. And what that does is has an effect on affordable housing for the residents of that community. This particularly penalizes renters within those areas, because they're not able to participate in the rising home values within that neighborhood as it gentrifies. They're simply driven out, often further out into other areas where their commutes are longer, access to services might not be as good as where they were previously. So gentrification, it's basically where you have rising home values, you have rising access often to amenities within that neighborhood, but you also have displacement. And it's often racialized displacement where Black families are oftentimes renters have to move to another area because it's more affordable. Revitalization, that's more of a situation in which you can have the rising values, you can have the improvement in the amenities access, but by the same token, you have sufficient affordable housing being put in place by developers and cities working with developers that it cushions the effect somewhat so that you don't have as severe displacement take place.
And then I imagine Adam's public comment letters that he talked about would be an important part of this equation. If if the community wants to, when you have the revitalization, et cetera, et cetera. So, well, gentlemen, thank you so very much for spending this time with us and really giving us lots of really good information. And again, I do believe we're going to have you back because I don't think we can ever talk too much about this issue because it's really important. So for those listening, thank you for spending this time with us. We want to thank our partners, the Prince George's County Memorial Library System. We want to also point you to the links in the chat, which includes the conversation in December that I just referenced with Bruce, with Chazzy Diggs, who was here, a dynamic real estate professional, and Charles Floyd, who is a senior investigator in our office, the Office of Human Rights. And also, please, for upcoming programs, please go to our website. Kyla put that up on the screen at one point, as well as the Prince George's County Memorial Library Systems website for future events. We want to highlight two. Tomorrow, we welcome D.B. Tipmore. He's going to talk about his book, My Little Town. So please come to that tomorrow night, 7 to 8. And then next Wednesday, we continue our series on disability discussions with Chris and Finley Talk Truth. So we hope that you will join us for those two events and many, many more. So thank you. We want everyone to stay safe during this Omicron period. And so thank you. Everyone have a wonderful evening.
Thank you.
Bye-bye.
Thanks, everyone. Have a good evening.
Thanks. Bye.